In this video we are going to talk about 9 best monthly dividend stocks to invest in. So before starting, please like this video and subscribe to this channel for our future updates. Despite recent modifications, certain things stay unchanged. We all have monthly bills to pay. Every month, you're supposed to pay your mortgage, car payment, phone and utility bills. Paychecks arrive every 2 weeks, so that's not a problem when we're working. Even in retirement, Social Security and, if you're lucky, pension payments come monthly. Sadly, our investment portfolios don't function that way. Monthly dividend stocks can help. Number 9. Main Street Capital. We know that Main Street was impacted harder than Wall Street. That's life. But what about BDCs? Here, Main Street is Wall Street. BDCs primarily fund middle-market companies through debt and equity. These are companies that have grown too big for bank loans and maintained earnings, but not big enough for a stock or bond IPO. BDCs exist to fill it. Main Street Capital, Maine, $46.61, is a top-notch BDC established in Houston. Lesser capable companies were less able to negotiate the lockdowns in the last 2 years. But the corporation endured, and its stock recently surpassed pre-pandemic highs. Main Street has a conservative monthly dividend policy, paying a modest monthly dividend and then issuing special dividends twice a year. This keeps Main Street out of difficulties and avoids the shame of a dividend decrease in years where earnings are down. Main Street's usual monthly dividend payout is 5.6%, excluding special dividends. Number 8. Broadmark Realty. In fact, Broadmark Realty, BRMK, $9.75, doesn't own mortgages or mortgage-backed securities. But it does a lot of the same. Broadmark administers a portfolio of deed of trust loans for real estate development and investment. Unlike AGNC or Dynex, these mortgage REITs mostly trade standardized MBS. Instead, Broadmark deals with less liquid construction loans. But BRMK is a conservative. The portfolio's weighted average loan-to-value is only 60%. In other words, Broadmark would only lend $60,000 on a $100,000 home. In the case of a borrower default, the corporation has a large mistake margin. Broadmark now yields 8.6% at current prices. The company started paying a monthly dividend in late 2019 and sailed through the pandemic. Number 7. Dynex Capital. Consider Dynex Capital, DX, $17.47. Dynex, like AGNC, is a mortgage REIT, although its portfolio is more broad. About 85% of its portfolio is agency residential mortgage-backed securities, although it also has exposure to commercial mortgage-backed securities and a modest allocation to non-agency assets. Remember that the COVID-19 bad market wiped out the mortgage REIT sector. Initially, it was unclear if millions of Americans would be able to keep paying their mortgages, leading speculators to sell first and ask questions later. In the ensuing carnage, several mortgage REITs suffered catastrophic losses, and some folded. Dynex is a survivor. And, really, any mortgage REIT that can withstand 2020's turmoil is likely to survive the apocalypse. The chance of ruin is low here. Dynex trades at a modest discount to book value and yields 8.9%. There may be some volatility if the Fed raises rates, but for now, this appears like one of the finest monthly dividend stocks to buy if you want to maximize your yield. Number 6. AGNC Investment. AGNC Investment, AGNC, $15.98, is a REIT, but it's not like Realty Income, STAG, or any of the other monthly dividend companies on this list. Rather than owning real estate, AGNC owns mortgage securities. It has the same tax benefits as a REIT, no federal income taxes if at least 90% of net revenue is distributed as dividends, but a significantly different return profile. Mortgage REITs, MREITs, are meant to generate income rather than capital gains. They are hence monster yielders. For example, AGNC generates 9%. Loudly say AGNC, doesn't it sound like agency? There's a reason. Fannie Mae, Freddie Mac, Ginnie Mae, or the Federal Home Loan Banks are the only issuers of agency mortgage-backed securities. This makes it one of the safest bets. Also, AGNC usually always trades over book value, which makes sense. We can't do what AGNC does and can't get the same financing. Its worth is reflected in the premium share price. AGNC trades currently at a 9% discount to book value. That's a great deal for this stock. Number 5. LTC Properties. Consider LTC Properties, LTC, $34.24 for a final conventional REIT. Although the pandemic's consequences are still persisting, LTC's outlook remains positive. LTC is a REIT with a portfolio that includes both senior housing and nursing homes. COVID-19 hit this area hard. Nursing facilities were prone to breakouts, and inhabitants were at risk due to their age. The residents in senior living apartments are often younger and live freely without medical care. But many prospective tenants were afraid to leave their houses and move into a more crowded building during a pandemic. Many are still. These residual effects won't go away. Ultimately, senior living facilities still provide an active lifestyle for many seniors. Then there is home care for many elders in need of competent nursing. Eventually, there are few alternatives to nursing home care. Notably, long-term demographic trends are unstoppable. Baby boomers are now in their early to mid-60s, far too young to require long-term care. But demand will continue to grow over the next 2 decades as more baby boomers reach retirement age. LTC has one of the highest monthly dividends yields on this list at 6.7%. Number 4. EPR Properties. The COVID-19 outbreak hit many landlords hard. But none was hammered like EPR Properties, EPR, $49.21. EPR's portfolio includes movie theaters, amusement parks, ski resorts, eat and play venues like Topgolf, and more. EPR focuses on experiences above stuff, which is a bad idea when social distance is the norm. Almost every EPR site was closed for a while, and attendance haven't returned to pre-COVID levels in many. Notably, the worst is behind EPR Properties, and the more regular life returns, the better for EPR's renters. Pre-pandemic, EPR was a reliable dividend payer. But with renters in a bind, the REIT cut its payout in 2020. With business conditions expected to improve in 2021, EPR restarted its monthly dividend in July, resulting in a 6.1% yield. When it comes to monthly dividend stocks, EPR is one of the best. Number 3. Gladstone Commercial. Consider Gladstone Commercial, good, $22.49, for another grim industrial piece. We have a broad portfolio of logistics and light industrial properties. Industrial properties generate roughly 48% of its rental income, while office properties generate another 48%. The remaining 4% is split between retail properties, 3%, and medical offices, 1%. It's a well-diversified portfolio that has weathered the recent market turmoil. On September 30, 2021, the REIT had 127 properties in 27 states leased to 109 tenants. We have grown our portfolio 18% every year since our IPO in 2003, says management. Our occupancy is 97.7% and has never been below 95%. That's a good run. Gladstone Commercial has also been paying a monthly dividend since January 2005. Good presently yields 6.7%. Number 2. STAG Industrial. Realty Income was Amazon.com proof. But STAG Industrial, STAG, $42.77, benefits from the expansion of online commerce. STAG invests in warehouses and light industry. Those rundown warehouses near the airport with 18-wheelers continually coming and going? STAG acquires and holds property like that. E-commerce is unquestionably on the rise, and STAG is well positioned to benefit. Amazon.com is STAG's largest tenant, accounting for over 40% of its property. For obvious reasons, e-commerce soared. The impacts of that rise have faded as businesses reopen, but the trend is obvious. We're buying more online. But there's more to come. According to Statista, only 15% of retail sales are conducted online. The logistical industry is also highly fragmented, with STAG's management estimating a market value of roughly $1 trillion. That is, STAG is unlikely to run out of opportunities soon. Not at all. In the long run, it's one of the top monthly dividend stocks to purchase in 2022. This market competitive 3.4% yield. Number 1. Realty Income. No other stock has been more closely related with monthly dividends than Realty Income, $70.91. The monthly dividend company even trademarked its official nickname. Of course, Realty Income is a stock, and its share price fluctuates like any other. But it's still the closest thing to a bond in the stock market. It offers reliable recurring rental income from over 7,000 homes and 650 renters. Realty Income specializes in high-traffic retail properties that are recession-proof and Amazon.com-proof. Amazon.com, AMZN, and other e-commerce behemoths may not be fully free of competition, but Realty Income gets close. Among its major tenants are 7-Eleven, Walgreens Boots Alliance, FedEx, and Home Depot. The portfolio had strong exposure to gyms and cinemas, making the pandemic difficult. But as the world returns to normal, Realty Income's COVID-19 risk decreases. Realty Income currently yields around 4.2%. Remember that the 10-year Treasury yields only 1.6%. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.